Let's take a look at the model. This is a three-stage DCF model with explicit forecasts for 2017, 18, and 19, and then a transition phase to a terminal value in 2026. To me, it seems reasonable to assume a high growth period of anywhere from 0 to 10 years. Beyond that point, it's hard to imagine that anyone could reasonably forecast free cash flow. Given the strength of Apple's brand and the almost cult-like following of its customer base, we used a 10-year forecast period. For the terminal value, we assumed a long-term growth rate of 2.3%, consistent with the yield on the 10-year Treasury bond. As noted earlier, we expect higher sales from the iPhone supercycle. The supercycle, combined with a mix shift to higher margin services segment, should result in margin expansion over the next few years. Obviously, we want to be sure that these figures that we use for revenue growth and operating income are backstopped. So we did a revenue roll-up for the company to be sure that our estimates were reasonable. We did the same for gross margins, looking at how the company's plan to double the services revenue would impact gross margins and ultimately the company's operating margins over the next few years. For reinvestment, we looked at the historical relationship between sales and the company's short and long-term investment needs. By deducting reinvestment needs from our after-tax operating income, we arrive at the company's free cash flow, which we expect to grow by 6.9% over the next 10 years. Discounting those free cash flows at the weighted average cost of capital of 9.3%, we arrived at a value for Apple of nearly $200, implying 17% upside from the stock's current price. Let's now look at the company's relative value. The company is currently trading at 15 times next 12 months earnings per share. To assess the current price multiple, we need to have a perspective on where the company has traded historically on both an absolute and relative basis. To gain that perspective, I've included a chart with the company's PE ratio over the past 5 years. The height of each bar reflects the range of the company's PE multiple during each calendar quarter. That's why there are 4 bars each year. The black line that bisects each bar is the average multiple for the quarter. As you can see, the company is trading near its 5-year high multiple. Not that it couldn't go higher, but we would have to make a case that the fundamentals for the company going forward are better than they've been over the 5-year period reflected here.